Income tax 2020, capital gains. Come in, relax with income tax 2020. Capital gains. When thinking about capital gains with regards to our income tax equation, we're going to be on line 1, the income line, remembering that we could basically break up our income tax equation into two halves. The first half basically being a modified income statement, the bottom half then being the calculation of the tax on the taxable income, then applying out the payments and credits to get to the tax refund or amount due. We're going to be up here on the income, considering the income portion, and the questions related to income are, is it something that needs to be included in income? And knowing that we would rather not include it if we don't have to by law, because if we include it in income, it's most likely we're going to be paying taxes on it. And if included in income, then do we pay the normal tax rate on it, which would be the ordinary income rates, the normal progressive tax rates, or is there some kind of special tax that we might be paying on that particular type of income? Capital gains can be a confusing component of income for many different reasons. We're going to be concentrating here on basically a summary of capital gains, and the major thing that will be included in capital gains for most individual tax returns that aren't heavily complicated returns, that being capital gains related to sales of stock. So stock sales will typically result in capital gains oftentimes, or losses that would be reported on a Schedule D and then pulled over to the 1040. However, capital gains themselves can be complicated in a concept and can basically take a whole course in and of themselves, because one, they're much more broad. They're a broad range of things that qualify into capital gains and different categories of the capital gains. Two, you can also have capital gains and losses that will be involved as well, and then the idea of what are you going to do with the capital gains and losses. Three, there could be differences between capital gains that would be reported with regards to the individual income taxes and with regards to basically business tax returns. So the fact that they could be somewhat different if you're talking about business tax returns, for example, corporations and whatnot, and if you're talking about individual taxes, it could be a little bit different. That can be confusing as well. 4, we also have to think about the basis that will be involved, the cost oftentimes to figure out what the gain will be. And then 5, we often have to be breaking out between short-term and long-term capital gains. The reason we do that is because 6, we often have a difference in the rates. So this is one of those areas where we would say, okay, is this something that should be included in income? If it is included in income, then are we going to be taxing it at different rates? And typically that will be determined by whether or not it's determined to be a short-term capital gain or long-term capital gain. Therefore, for purposes of us including it now, we're really focusing in on those things that are going to be the most common components that would be included in capital gains. That would be the sale of stocks. But just realize that the category of capital gains is going to be much wider than that. Also note that for individual tax returns, another common component for capital gains would be like a sale of a home. And there are special rules related to the sale of the home. That doesn't happen all the time, but it comes up from time to time. It's just normal taxpayers, tax lives here. So there's special rules to that. We're not going to get into those here. We might touch in on that later, but just keep in mind that there's usually special exemptions and whatnot related to a home sale, although it's going to be following capital gain rules to some extent as well. Okay, so we're on looking at the 1040 here to consider the capital gain, and this is the 2020 1040, and it would be reported on line 7 here, capital gains losses. I know this is small. We'll go into it in more detail in a future presentation when we'll actually work through some practice problems so you can see it on the 1040. But the point is that this line 7 is often supported then by a Schedule D. A Schedule D, again, we'll get into in a future presentation to actually look at it and see some calculations within it. But it will typically have a Part 1, short-term capital gains, Part 2, long-term capital gains, and then it'll feed in the gains and losses into basically the 1040 form on the front page, and then we can do what we need to do from there. Now, normally when you have capital gains, for most of the capital gains you're going to be recording, if you're doing individual taxes or your own taxes, are going to be from stocks and bonds. There was a sale of stocks and bonds. The taxpayer has money in mutual funds or stocks and whatnot. They sell something, and therefore the brokerage company is required then, like a normal 1099, the brokerage company is considered kind of like the manager or kind of like the payer, or at least the intermediary, and therefore they are the ones responsible to be sending out the 1099. Like all 1099s, typically means that this is something that we could potentially need to be including in income. It also means that a copy of this went to the IRS. Therefore, if we do not include something in income, then it's likely the IRS is going to send us a note saying, hey, you should have recorded this in income. So we've got the payer's name, the payer's TIN, tax identification number, the recipient's TIN, recipient's name, address, and so on and so forth. The account number over here. And then in box 1A, we got a description of the property. So we got the description of the property. Now, also just realize that you might be getting this from a brokerage companies or banks. So that you might get this from a bank, whoever's managing the brokerage accounts, or some type of financial institution. It might not look exactly like this or be the format looking like this. However, the boxes will be the same. And therefore, if you need to look something up for a particular box, you can take a look at the instructions, and those should be standardized. So we have the date acquired. Now, hopefully, more and more, the IRS is giving pressure on the brokerage companies to give the acquisition dates and the basis or cost, because that's going to be necessary for the tax returns. Obviously, that's a whole lot more work for the brokerage companies to be doing, but that's kind of what we need to do the tax returns. So we got the date acquired, the date sold. Now, that's pretty clear. Typically, the date sold is going to be in the current year. That's going to be the thing that triggers the taxes. So if you sold stock, that's the thing that usually triggers the tax. Then we got the proceeds. That should be known because obviously that's how much we got in the year we sold it, which is this year, in this case 2020. I know this is a 2021 form here, but we're generally thinking 2020. And then wash, sale, loss, disallowance. That's usually not going to be applicable. Short-term gain or loss, long-term gain or loss. So we have the actual indication here as to whether it's short-term or long-term. Check if processed from collectibles, federal income tax withheld. Not always the case that you're going to have withholdings, but you might have withholdings with these items as well. So you might even advise, someone might ask for advice on how much should I withhold if I'm selling a substantial amount of stock that's not in a 401k plan, meaning I'm going to have to pay taxes on gains or loss for it. But oftentimes that's not included. Check if non-covered security. Reported to the IRS gross proceeds, net proceeds, so whether they got the gross or net. Check if loss is not allowed based on amount D1, profit or realized 2021 on closed contracts, unrealized profit. And so these are less common items down here. Notice when you have stock, the idea would be that you're going to be buying the stock. It's going to go up in value, you're hoping. And then when you sell it, that's when you recognize the gain. So just realize that when you're thinking of stocks, basically, if I bought it in year one, for example, and I bought it for $100, and then in year two it went up to $200, I don't typically pay any taxes on that, even though it went up in value. And I know that it went up in value based on the stock market because I haven't realized it. I haven't yet sold it. And then in the year of sale, which may be 3 years later, I sell it. At that point in time, that's the point in time that I'm going to realize the gain. So if I went up to like $300 at that point, then I sell it and I realize the entire gain at that 1 year in which the gain took place. The fact that we have that kind of deferred gain and we don't recognize it, we don't recognize the gain or record the gain or pay taxes on it until we recognize the gain, until we make the sale, can cause issues. Some of those issues will be that it's difficult sometimes to get the cost or basis, because the cost or basis might have been something that you bought 10 years ago, or worse, you inherited it or something like that, or someone gave it to you or something for prior to that. And then you got to figure out, okay, what was the cost or basis? How much did I buy it for? Because I need to know both the cost and the sales price to figure out the gain on it. And that's going to be, one of the problems that are often going to be the case that we will have. Now, if you have any kind of issues with this, you have the instructions on the 1099. They typically will come with the 1099, or you can look them up on the IRS website, and then you could go to each of these boxes and get more detail on what each of those boxes then means. So most of the information we're going to look at now is actually coming from the 2019 instructions for Schedule D. 2020 is not out yet, but I'll try to reference anything that would be substantially different in the 2020 instructions. So just be aware of that. Obviously, if you have questions about data input into the system, the one place to start would be the instructions for the form, that being Schedule D, typically where we're going to be recording the capital gains. So use Schedule D to figure the overall gain or loss from transactions reported on Form 8949, sale or other disposals of capital assets. Now, I'm going to go over, the reasons why you would have when you would use a Schedule D here, which would be capital gains and losses. And remember that I'm going to go over a broad category of them, just to give you an idea of what would be included or could be included. But usually, and what we will focus in on and zoom in on, are stock sales that will typically happen. And we might go into more detail on gains or losses in a future presentation, on capital gains and losses in future presentation. So this is a sale and other dispositions of capital assets. To report certain transactions, you don't have to report on Form 8949. To report a gain from Form 2439 or 6252 or Part 1 of Form 4797, sale of business property. So again, we might go into more detail on some of these items in a future presentations, these different circumstances here. To report a gain or loss from Form 4684, 6781, or 8824, casualties and thefts, gains and losses from Section 1256, contracts and straddles and like-kind exchanges. To report a gain or loss from a partnership, S corporation, estate, or trust. So again, more complex returns might have more of these involved. Business returns might have more of these items involved. We might then have passive income like an S corporation or a partnership or a trust or something like that that is flowing through and have capital gain that would be involved with that. Again, those things would typically happen in more complex returns, and we might be going into them in more depth in future presentations. To report capital gain distributions not reported directly on Form 1040 or 1040-SR, to report capital loss carryover from prior years. Now, one of the concepts or components of capital gains and losses that are confusing is that, of course, it's possible to have a loss. Our focus, once again, will typically be on the sale of stocks, because that's what's most common. And it's quite common, of course, to have a loss on the sale of stock, meaning you sold it for less than you bought it for. So now you got a loss. Well, the gains, of course, will be included in income. What do you do with the losses? And so normally, if you had gains and losses that happened in the same year, you're going to net them out. And if you have and this is a general rules because it gets complicated because there's short-term gains and long-term gains. But generally, if the gains and losses happen in the current year, you'd net them out. And then you would record, if there's a net gain, you'd record the net gain as the net capital gain. And if there's a loss, then there's a question, because the IRS is going to be saying, hey, we're skeptical of losses. Because if you have losses, that means, the IRS, you're going to be deducting or reducing other income. So if you had W-2 income and then you had a capital loss, then you might be reducing your income that you would have had from other sources. The IRS is skeptical of losses, so the IRS will typically limit losses. And if they limit the loss in the year you have, usually to like $3,000, then the question is, well, do I just lose the loss altogether? Or can I take advantage of it in a future year or something like that? And usually you can carry it forward to the following year and either net it out against the capital gains or possibly take another $3,000 loss. So that results in us having these carryovers of losses, which can kind of complicate things as well with regards to the calculation of capital gains and losses. So capital assets, so we'll go into a little bit more detail on what a capital asset is. Capital asset, most property you own and use for personal purposes or investment is a capital asset. For example, your house, furniture, car, stocks, and bonds are capital assets. Capital assets is any property owned by you except the following. So we're going to go through the exceptions. Again, notice what we have up here: house, furniture, car. Now the house is sold from time to time, and obviously that's a huge thing, and it's a capital asset, but it's got its own kind of rules and its own exemptions. So you want to go into those specifically. That doesn't happen all the time, but it happens from time to time, and you want to have some familiarity with it. With regards to like furniture, car could be sold from, and you might have capital gains with relation to the car. But furniture, oftentimes people aren't, it's a capital asset if you sell it, but oftentimes people aren't in the business of selling furniture, and they may not be making a gain on the sale of the furniture and whatnot. So it's not something that is typically a big issue for most taxpayers. Whereas the stock, of course, will be bonds could be an issue as well. So that's why for individual taxpayers, we're typically concentrating in on the sale of the stocks and bonds. So once again, capital asset is any property owned by you except the following: stock in a trade, other property included in inventory or held mainly for sale to customers in the ordinary course of your trade or business. But see the tip about certain musical compositions or copyrights. So in other words, if I have something, if I own something and I intend to resell it, then it's not a capital gain because it's inventory. That means it would be inventory, so when I sell it, it would be part of cost of goods sold because that's part of my normal business process. And so that's going to be like an exception. 2, accounts or notes receivable. A, for services rendered in ordinary course of business, or B, for services rendered as an employee or from sale of stock in trade or other property included in inventory or held mainly for sale to customers. So typically, not the accounts receivable would not be a capital asset. Depreciable property used in your trade or business, even if it is fully depreciated. So you could have like the same property, but if it's business property, could be different rules with relation to the business property. 4, real estate used in your trade or business. So again, we got real estate, but it's within the trade or business. We're not talking about personal real estate. We're not talking about basically the home. 5, a patent, invention, model, or design, whether or not patented, a secret formula or process, a copyright, a literary, music, or artistic composition, a letter or memorandum, a similar property that is A, created by your personal efforts, B, prepared or produced for you in case of a letter, memorandum, or similar property, or C, received under circumstances such as by gift that entitle you to the basis of the person who created the property or for whom the property was prepared or produced. And 6, a U.S. government publication, including the congressional record that you received A, from the U.S. government or any government agency for an amount other than the normal sales price, or B, under circumstances such as by gift that entitle you to the basis of someone who received the publication for an amount other than the normal sales price. 7, certain commodities, derivative financial instruments held by a dealer and connected to the dealer's activities as a dealer. So once again, you kind of got this business exception here. 8, certain hedging transactions entered into the normal course of your trade or business. And 9, supplies regularly used in your trade or business. So once again, capital asset, most property you own and use for personal or investment is a capital asset, and they include major things: the house, furniture, car. We're focusing typically on stocks and bonds here. Remember, the house has that special kind of case with exemptions that you want to make sure that you are taking into account when those happen. So basis, what is the basis? So basis is the amount of your investment in property for tax purposes. So that'll typically include mainly the cost. So when we're thinking stocks and bonds, how much did we pay for the stock is going to be important, as well as any kind of expenses related to the managing or the sales. If the sale costs anything, we had to pay the broker, then that could have an impact on the gain or loss. So the basis of property you buy is usually its costs. There are special rules for certain kinds of property, such as inherited property. So notice that if you say, okay, well, the basis is going to be cost, right? And then you have a situation where someone inherited the property, well, then you got to go into the inheritance rules. And once again, most of the times this information oftentimes will be provided by the broker. But if it's a longer kind of situation, the broker is more likely not to have the information, right? They might not have the information if it was inherited and that you've held on to this thing for a very long period of time, especially if you've changed from broker to broker, then that's where it becomes a more complex type of situation. You need to know your basis to figure any gain or loss on the sale or other disposition of the property. So this is going to be a key factor, and it used to be that the IRS or the government really only forced or required the broker to record the sales price and didn't have as much pressure. They're applying more pressure now to have them provide the cost or basis. And if you only have the sales price, that's not enough, because what's going to happen is you're only going to record the sales price, or the IRS only knows about the sales price. And if you don't include the basis, then you're going to have a lot higher tax, right? You're going to be paying on the sales price as opposed to the gain, the difference between the sales price and the cost. So it's important to get that cost in there. Also note that if you simply do not report the gain or loss, then the IRS is likely to send you a letter based on solely the gain and say that you will based on the sales price as opposed to the gain, sales price minus the cost. Because again, oftentimes the IRS only has that information. They may only have the sales price. That's what's been given to them. You need to provide them with the cost so that you're allowed to reduce your taxes by recording only the gain and paying taxes on only the gain rather than the entire sales price. So you must keep accurate records that show the basis and, if applicable, adjusted basis for your property. Your records should show the purchase price, including commissions, increases to bases such as the cost of improvements, and decreases to bases such as the depreciation, non-dividend distributions on stock and stock splits. Now, again, if you're doing basically stocks here, you could have these non-dividend distributions and stock splits and whatnot. That could greatly complicate the calculation of the basis. Hopefully, at this point in time, your brokers are going to be helping you out and helping to handle that information. But that's going to be applicable to the stocks. Notice that when you're talking about like depreciation or improvements, that might be applicable to say something like the home, right? Which is less common to be having a sale from, but it will happen, of course, from time to time. So if you're thinking about the home and the home sale, then or something, a large kind of item like that, then you're thinking about those types of items such as improvements and whatnot. When you're thinking about the stocks, again, you're kind of dependent on the broker, and the things that could have an impact on the cost are things like stock splits and whatnot, which could have an impact on what the basis calculation would be for the cost of the stock. So then we have the concept of short-term gains and losses and long-term gains and losses. And these are going to be important because oftentimes the IRS or the government or the law will provide better tax rates for long-term capital gains and losses, either 0%, 15%, or 20%, but in essence, typically being something that's going to be beneficial depending on the tax bracket. So in other words, short-term will typically be on ordinary income tax rates, and long-term, you could get the beneficial tax rates of 0%, 15%, 20%. This is something that could change basically from year to year. They're always debating as to whether or not you should have a tax benefit for capital gains, and then, of course, what that benefit would be. Why would you have a tax benefit for capital gains? There's a few different arguments for it, of course. One would be that it's something that could stimulate the economy, because obviously we want to incentivize people to be investing in the corporations by buying stock and whatnot, and to do that to give favorable tax rates for the gains that would be on the purchases, to make it more likely that they're going to have a positive experience. They're going to be generating revenue is one reason. Another reason is that basically when you put money into stocks, often you will hold on to it, as we said, for a long period of time. So if you put it in and then you sell it 30 years later, if you buy stocks and you sell it 30 years later, well, 30 years later, you're going to be recording the gain on that was really accumulating for the entire time period. So the gain could be high because of that. If you report all the income in 1 year, then you might end up in a higher tax bracket than you otherwise would if you were to recognize the gain, a little bit over 30 years, a little bit at a time. So they don't want a situation where people are disincentivized to put money into the stock market and feel like they can never take it out, because if they take it out, they're going to be hit with basically a tax on it, especially if they take out a large amount that's going to be increasing their tax rates, and they'll have a higher ordinary income tax rate because of the progressive tax system and so on. So then they often will offer better rates, and that's some of the rationale for it. But obviously that's always in debate. So in any case, the short-term gains and loss report short-term gains and losses in Part 1 of the Schedule D. The holding period for short-term capital gains and losses is generally 1 year. Now that's just basically an arbitrary rule. So if you're talking stocks and bonds, if you held on to the stocks and bonds for less than a year, then it's going to be short-term, and you will typically often be subject then to ordinary income rates, the normal progressive tax rates. Report long-term gains or losses in Part Part 2, the holding period for long-term capital gains as losses is generally more than a year. So if it's more than a year, it's just considered long-term at that point, and then you could get the favorable tax rates, basically the long-term capital gains rates. Now this of course leads to questions in terms of, well, what if you have some of your gains in the short term and long term, but what if you have like some short-term losses and then some long-term gains? I mean, how do you net those things out? Because the general rule, of course, is that you're going to net out the gains and losses. And if you have more gains than losses, then you're going to record the gains. And if the gains are long-term, then you're going to be paying favorable tax rates typically if offered. And if they're short-term gains, then you got to pay the ordinary income tax rates. But it gets a little bit complicated because you can see all the combinations that start to rise up here when you could say, well, what if I had short-term losses and then I had long-term gains? How do I net those things out? And of course, then if you have the losses, then how much of the losses can I basically deduct? If I get $3,000 a year of losses, I'm going to be limited to the losses. And how do the rollovers work with regards to short-term and long-term losses? I'm not going to go into those in a lot of detail here. We might go into that in more detail in future presentations, but just realize the general rule here. Long-term gains and losses. Long-term gains typically will have favorable rates. Short-term will typically not have favorable rates. If you have losses, then the IRS will limit the losses and you may be able to take care of them or get a benefit from them in future years. So capital losses then. Now, we're concentrated in on gains here, but when you talk about capital gains, you got to think about losses too, because the losses will typically net out against the gains, and then you'll have a net gain or loss. If it's a net gain, you got to record it in income typically. If it's a loss, then the question is, do I get a deduction for it? I'd like to lower my income by the loss I had. That means that you sold something for less than you bought it for, right? The basis is higher than the sales price. So you can deduct capital losses up to the amount of your capital gains plus $3,000, $1,500 married filing separately. So you may be able to use capital losses that exceed the limit in future years. So the IRS is saying, okay, we're going to let you take the capital losses, but we're skeptical of losses. We'll let you take up to $3,000 a year, and then you're not going to lose the excess losses per se. We will let you roll them over into the following year. And if you have capital gains that you can net out against the capital losses in the following year, in other words, you sell more stock, then you might be able to net them out. If not, then maybe you can take $3,000 of the losses next year, and then it'll roll over. Whatever's still rolling possibly could roll over to the next year. That's kind of like the general rule for the IRS with the losses. Note, from a practical standpoint, it's really useful to have the software to help you with these rules. So you want to know the general rules so you could talk to clients with them and whatnot. And then of course you want the software to help you. Now, for the software to help you out with loss carryovers, then you got to make sure that you did the return last year, you pro forma the return into the current year, and then hopefully the carry forward should carry forward. If you have a new client and they have capital losses and more complex returns, then you might want to actually enter the data into the prior year's return, in this case in 2019 year return, pro forma it forward, and then hopefully all the losses should then more likely to be able to roll over into the current year properly, and then you can move forward from there.